Welcome back. So today we're diving into this really fascinating paper from the Bank of England, and it uncovers a genuine puzzle right at the heart of the financial markets. It's all about how the price of one of the safest investments you can possibly imagine can sometimes be, well, just plain wrong.
I mean, it really all comes down to this one question, right? Think about it. UK government bonds, we call them gilts, they're supposed to be the absolute gold standard of safety. Their price should be a perfect, pure reflection of their real value. But as researchers dug in, they found that, yeah, that's not always the case. Something out there is actually distorting the price of one of the safest assets on the entire planet.
And the scale of this distortion, honestly, it's pretty shocking. Their paper finds that these hidden frictions deep inside the financial system's plumbing can push bond prices off their fundamental value by as much as 4 percentage points. I mean, for an asset that's supposed to be the benchmark for the entire system, that is a huge deviation. It's wild.
So, you're probably wondering, how on earth did they figure this out? Well, it turns out the researchers got this incredibly rare peek behind the curtain. They got their hands on proprietary, super detailed, transaction-level data from both the UK bond market and this other market we'll talk about, called the repo market. And with that data, they could trace these distortions right back to their source.
All right, so let's break this down. First things first, we got to really get a handle on the core problem itself. Let's talk about the gilt pricing puzzle.
Okay, so gilts are the bedrock of the whole system. Seriously, their yields are used to price pretty much everything else, from corporate bonds all the way down to home mortgages. So when their price starts to drift away from where it should be, it's not just some academic thing to puzzle over. No, it's a huge signal that something, somewhere deep in the market's machinery, just isn't working as smoothly as we all assume.
So, to find the source of this mispricing, we can't just look at the bond market on the surface. Nope, we have to go deeper. We need to get into the real engine room of the financial system, the repo market.
The best way to think about the repo market is like the high-pressure plumbing of finance. It's this massive, multi-trillion-pound market where all the big players, banks, hedge funds, pension funds, are constantly exchanging these huge short-term loans, and they use super safe stuff like gilts as collateral to back them up. It is absolutely essential for keeping money moving, but here's the catch. It operates almost entirely out of public view.
Okay, so inside this market, there are two key transactions, and this distinction is super important for the rest of our story. In a repo deal, a dealer provides cash and takes a gilt as collateral. Simple enough. But in a reverse repo, it's the other way around. A dealer receives cash and provides a gilt. Now, who is on which side of that trade? Well, that turns out to be the key to everything.
And this is exactly why that distinction matters so much. The market isn't one big happy family, it's segmented. On one side, you've got hedge funds who are desperate to borrow very specific gilts for their strategies. And on the other side, you've got pension funds who are looking to raise cash using the gilts they already own. You see? This creates two totally different worlds, two completely different dynamics within the same market.
Okay, so now that we've got the lay of the land, we can zoom in on the first source of friction the researchers found, and that is the power of the dealers who sit right in the middle of all these trades.
So what do we mean by market power? Well, in simple terms, it's just a dealer's ability to kind of nudge the terms of a trade in their own favor. Since they're the middlemen, they can add a little markup when they're lending cash or a markdown when they're borrowing. It lets them capture a little bit of extra profit that just wouldn't exist if the market were perfectly competitive.
So to actually measure this, the researchers came up with this really clever two-step process. First, they built a model to calculate the market power of every single dealer. Then, they took that score for each dealer and measured how it directly affected the mispricing of the specific gilts they were trading. Pretty smart.
And what they found was really interesting. Dealers don't typically use their power to just say no and stop a trade from happening. That's not how it works. Instead, they use that power to influence the price of the trade. That's the repo interest rate. They're just subtly altering the cost of money, and that's exactly where the distortion starts to creep in.
Right, and this distortion isn't spread out evenly. Remember that whole market segmentation thing we talked about? Well, check this out. The impact is way more powerful in the reverse repo market. And that makes sense. That's the side where the hedge funds are all competing to borrow those specific, in-demand gilts from the dealers. That competition gives the dealers a ton of leverage to set their own terms, and that's what pushes the gilt's price away from its true value.
So what's the bottom line here? Well, according to the paper, just this dealer market power, on its own, can account for up to 1.3 percentage points of that total bond mispricing we saw earlier. Now, that is a huge piece of the puzzle. But believe it or not, it's not the whole story.
See, the power of one single dealer is only part of it. The second, and actually even bigger source of friction, comes from what happens when shocks cascade through the entire financial network.
Let's go right back to our plumbing analogy. Imagine one of the main water pipes in your city gets clogged up. It's not just going to affect the houses on that one street, right? The pressure drops for the entire neighborhood. Well, the financial system works in a very, very similar way when one of its major dealers runs into trouble.
And what the researchers found is that the duration of these shocks is absolutely key. You can think of it like a traffic jam. A transitory shock is like a little slowdown that clears up pretty quickly. No big deal. But a persistent shock, that's like a major road closure. It's a fundamental problem that snarls up the entire network for a long, long time, and its impact is just so much bigger.
And this right here, this is probably the paper's single biggest finding. As powerful as an individual dealer's markup can be, the effect of these persistent shocks rippling through the whole network is even greater. What that tells us is that these system-wide problems are actually a more powerful driver of mispricing than any single firm's behavior. But here's where it gets really weird, a totally unexpected twist. A persistent shock that hits the dealers serving the hedge funds, it actually makes the mispricing worse. But a shock on the other side of the market, the side with the pension funds, can actually reduce the mispricing. It's wild, and it all comes back to those two completely different dynamics playing out in the same market.
Okay, so we've found our two main culprits, the power of individual dealers and the system-wide network shocks. So what? What does this all mean? Why does this deep dive into the financial plumbing actually matter to any of us?
Well, the big takeaway is this. The hidden structure of these really core markets creates frictions that can seriously warp the price of what we think of as our safest assets. It's not just one single thing, it's a combination of stuff. You've got dealer power messing with prices, the way that power is spread out across the system matters a ton, and these persistent shocks can ripple out and affect everybody, especially through that super competitive reverse repo channel we talked about.
At the end of the day, the paper has a really clear message for policymakers. Look, if we want to make sure the financial system is stable, we have to get a much clearer view into this essential market plumbing. Regulators need better tools to keep an eye on these frictions and to make sure that these core funding markets, especially the repo market, can actually handle the shocks when they come.
And so that leaves us with one last big question to think about. This whole analysis has shown us how the very structure of a core financial market can twist the value of an asset that we all just take for granted as being perfectly priced. So it really makes you wonder, if this can happen to something as safe as a UK government bond, what other unseen frictions are out there quietly shaping the markets all around us every single day?